Can you imagine having access to a treasure map that, instead of buried gold, guides you to financial freedom? We are not talking about magic formulas or tricks that promise instant wealth. We are talking about proven and simple rules, which one of the most successful investors in history has followed for decades to amass a fortune of more than $140 billion. Now, let me ask you a question. Why do so few people apply these rules? It's not that they are complicated or that they require advanced financial knowledge. The problem is something else. We live in a world where patience is considered obsolete and discipline is a luxury that few are willing to pay for. Warren Buffett, known as the Oracle of Omaha, has dedicated his life to mastering the art of investing. And even though he's publicly shared his principles time and time again, 99% of people simply ignore them. Why? Because following these rules requires something many fear: going against the grain, staying calm in the chaos, and understanding that real wealth isn't built overnight. Today, we will reveal to you the 7 rules that Buffett has applied to turn every dollar into a money-making machine. This is not a video for dreamers, but for those who are ready to take action. Are you willing to listen to what most people don't want to apply? If you do, you could change your financial destiny forever. Rule 1. Invest only in what you understand. Warren Buffett has said it countless times. Never invest in a business you can't understand. Although it seems like basic advice, few people put it into practice. In a world obsessed with the latest fads, such as cryptocurrencies, artificial intelligence, or tech startups, many forget that investing is not a gamble, but an exercise in logic and patience. Buffett, faithful to this principle, has focused his portfolio on companies that he deeply understands, such as Coca-Cola or American Express, where he knows not only the product, but also the structure of the business and its long-term potential. One illustrative example was his reluctance to invest in technology for decades. Even though many of these companies generated huge profits, Buffett admitted that he didn't fully understand how they worked or how they could sustain those margins over time. When he finally invested in Apple, it wasn't because of its technological innovation, but because he recognized that it was more than just a maker of tech devices. It was a recognizable brand with very loyal customers. Warren's company, Berkshire Hathaway, first invested in Apple in 2016, when its share price was around $25. Today, Apple is trading above $250. The lesson is clear. If you can't explain in a couple of minutes how a company makes money, don't invest in it. Rule 2. Buy businesses, not stocks. For Warren Buffett, buying a stock means acquiring a piece of a real business, not just a number on a screen or a stock ticker. His philosophy is clear. Before investing, ask yourself if this is a company you would want to own if it were private and if you would be willing to hold on to it for years. Buffett looks for companies with durable competitive advantages, strong management teams, and a proven track record of generating profits. One of his most famous examples is his investment in the Washington Post in the 1970s. At the time, the paper's stock was undervalued due to uncertainty in the market. However, Buffett saw the true value of the business, ignored short-term fluctuations, and held on to his investment for years. That bet ended up earning him a return of nearly 10 times his invested capital. Another example is his commitment to companies like Coca-Cola, where he has maintained his stake since the late 1980s because he believes in the lasting value of the brand and its business model. Even in times of crisis, Buffett avoids selling because he trusts in the long-term potential of the business. For him, the key is to focus on the fundamentals and not get carried away by market emotions. So stop looking at stocks as just numbers and start looking at them as real businesses that you'd like to own for the long term, with the patience and focus that have made Buffett a legendary investor. Rule 3. Harness the power of compound interest. Compound interest is the 8th wonder of the world, Albert Einstein once said. However, most people don't really understand how it works and lack the patience to let it work its magic. Compound interest involves reinvesting earnings continuously, allowing money to grow exponentially over time. Buffett began investing at age 11, buying his first stocks with savings from delivering newspapers. Although his initial investment was small, he understood from a young age that time was his greatest ally. Much of his fortune, which places him among the 10 richest people in the world, comes not from spectacular investments, but from decades of letting compound interest do its work. To illustrate, imagine you invest $3,000 at a 10% annual rate and reinvest the earnings. After 20 years, you'd have just over $20,000. But if you hold that investment for 40 years, the same amount would grow to over $135,000. The difference isn't how much you invest, but how long you let your money grow. Buffett is the perfect example of this strategy. 99% of his fortune was accumulated after the age of 50, thanks to his commitment to long-term investing. Start as early as possible, be consistent, and let time do the rest. Patience and discipline are your best allies in building wealth. Before continuing with the list, if you find this information useful, I invite you to give it a like and subscribe to the channel to stay up to date with new content. Rule 4. Ignore the market. Warren Buffett once said, "The market is like a bipolar man. One day he's euphoric, the next he's depressed." For Buffett, the key is not to get carried away by emotions. Average investors tend to buy when prices rise, for fear of being left out, and sell in panic when prices fall. This impulsive behavior is exactly the opposite of what he recommends. While this may sound theoretical, Buffett has actually demonstrated his strategy on multiple occasions. In 2008, during the global financial crisis, panic was rife in the market. While many were selling, Buffett saw an opportunity in the midst of desperation. Instead of going with the flow, he invested $5 billion in Goldman Sachs, which allowed him to make billions when the market recovered. These types of decisions are an example of how to use the market's fear and greed to your advantage. The advice is simple. Tune out the market noise and don't get carried away by emotional ups and downs. Instead of following the trends of the moment, it is essential to trust your own analysis and stay calm. In Buffett's words, investing is a long-term process, not a sprint. Taking the time to think and act calmly can be what makes the difference between success and failure. Rule 5. Buy with a safety margin. One of Warren Buffett's most important rules is to buy stocks that are undervalued relative to their intrinsic value, what he calls the margin of safety. This concept works like a cushion that protects your investment if things don't go your way. Imagine you want to buy a house worth $200,000, but manage to negotiate a price of $150,000. That margin of safety protects you in case the housing market goes down or unexpected problems arise with the property. With stocks, the principle is the same. Buy when the price is below its true value, so that you have a margin for error. Buffett applied this principle masterfully in 1962 when he bought shares of Berkshire Hathaway, a struggling textile company, at a rock-bottom price. Although the textile business eventually failed, the margin of safety allowed him to use Berkshire as a platform to later build an investment empire that is today one of the largest in the world. This purchase turned out to be one of the most profitable decisions of his career and allowed him to successfully diversify his investments into other sectors. The important thing here is not to overpay for an investment, even if it looks promising. Buffett has always looked for companies that are undervalued and offer a good margin to deal with unforeseen events. In his own words, it is much better to buy a wonderful company at a fair price than a fair company at a wonderful price. Rule 6. Patience is your best ally. One of the most famous quotes from the Oracle of Omaha is, "The market is a mechanism for transferring money from the impatient to the patient." While many investors seek quick profits, Buffett understands that the best investments take time to mature. His success has been based on being patient and waiting for his investments to pay off over the long term. A prime example of this is his investment in Coca-Cola. In the 1980s, Buffett purchased a significant stake in the company for approximately $1.3 billion. Instead of selling his shares for an immediate profit, as many investors would have done, he has held on to them for over 40 years. Today, that investment has generated billions of dollars in dividends and has been one of the most successful in the history of his portfolio. The reason many investors lose money is because they don't have the patience to wait. They sell too soon, either out of fear or impatience, thereby missing out on the long-term rewards that only come with time. Buffett, on the other hand, has shown that by keeping a long-term mindset, investments can grow significantly. His focus isn't on quick profits, but rather on investing in companies that have the potential to generate value for years. Adopt a patient mindset, stick to your decisions, and let your investments grow over time. Rule 7. Learn to say no. Buffett says the difference between successful people and really successful people is that the latter know how to say no to almost everything. In the investment world, this means rejecting opportunities that don't align with your rigorous criteria, no matter how attractive or tempting they may seem. According to Buffett, the key to long-term success is to focus on what you truly understand and what has the greatest potential, while avoiding distractions that divert your focus. An example of this is how Buffett has turned down numerous investment opportunities, even when they seemed lucrative. One famous instance occurred in the 1980s when Buffett turned down the offer to buy Disney, despite its success in film, simply because he didn't fully understand the business at the time. Instead of jumping into buying something he didn't understand, he chose to focus on companies like See's Candies and Geico, which better aligned with his investment style. This principle applies not only to the world of investing, but also to everyday life. Knowing how to say no to distractions and focus your efforts on your main goals can make the difference between success and failure. This has allowed Buffett to focus on a few key investments, which over time have generated extraordinary results. So, as hard as it may be to believe, saying no can be the key to success. Warren Buffett's investment rules are simple in theory, but they require discipline, patience, and a consistent commitment to apply. Most people don't follow them because they go against human emotions and market trends. However, as we have seen, these rules have proven to be effective over the decades. Are you willing to think and act differently than the rest of the world? If you can do so, you could transform your financial future. As Buffett says, you don't need to be a genius, but you do need to have the right temperament. If you found this video useful, don't forget to give it a like and subscribe to the channel so you don't miss the next content. See you next time.